Property is called Valley Center, and this is located in Valley Ranch, Texas. And we'll show you the location here in a second. But here's a picture of the building. This is the front side of the building, right on the corner, right here. So you have a great pull through, and it's a 3-story building with a large atrium. I'm going to go through the purchase, why we like it, which is a great return on investment on it. Great cash flow with upside. We'll show you that. Now, we're doing things a little bit differently. This is a 506C for accredited investors only, and there is a third-party verification that's going to be required on that. And there's only a $25,000 minimum. Now, the reason that we're doing the 506C with the lower minimum is to allow us to advertise for additional investors. We've been going back to the same group. We've raised close to $100 million, but we want to expand that so there's more opportunity for other people. And the lower minimum will allow people to test the waters with us and see how we do. This all began because we need a corporate headquarters, and I wanted to expand our education and training. And so we started looking at lease space, we started looking at buildings, location, etc. And we found that, first off, space is expensive beyond belief. And second, nothing met our requirements. So we said, wait a minute, we're owners. We can do this. I've owned plenty of office buildings. We know how to invest in properties. And so let's go ahead and find something available for us to buy. And we found what we think is dang near the perfect building. And we'll tell you all about that in a second. Here are some sample numbers that we ran through. So, for example, if somebody invested $100,000, they can expect a 6.3% cash-on-cash return year one, 8.2 in year two, 10.2 in year three, 10.6 in year four. And then after the sale, a total of an average of 16.3% average per year return. Now, I'm going to show you how this is an extremely conservative number. And we're going to go through all the numbers so that you can see exactly why I think this is so conservative. Now, the final PPM numbers may look a little bit different, and the PPM should be ready next week, but you'll see why I am saying that here in a moment. For those of you who don't know us, we've done $500 million of transactions. We've been investing for 30 years. Our average return across every investment, 18.3% average return over 30 years, had over 8,000 apartment units and millions of square feet of office and multifamily properties. So our team is extremely experienced in this, and we have a pretty deep bench with a lot of talented people. Here's the property again. The view of the property. This is looking southeast. So north is to your left, down toward the left corner. This is the back side of the building. Brick veneer, glass windows, obviously glass windows. That was kind of a dumb thing to say. It's glass and brick veneer. The roof is new. The air conditioners are new. It's in great condition. We love it. Here is the atrium area. Now, it's dated. The property was built in 1986, and you can kind of see the mauve tiles on the wall and kind of mauve tiles on the floor. Well, we have budgeted $950,000 in CapEx to go into this property. The majority of that is for TIs and commissions, so that not for us, TIs and commissions for outside leasing agents, and to go ahead and upgrade the units, upgrade all the suites, so that we can get higher rents, because rents are about $5 below market across the board. This is an office medical building, so there's a lot of medical tenants in here also. And for those of you who don't know, medical tenants never move. They build too much on building their business. They've got too expensive TIs, so they stay here forever. So the stability of the medical tenants is spectacular, and everybody else, they don't move a whole lot. So even though we have lease expirations that are shorter term leases, anywhere between, usually the average term lease is about 3 years, and because of when they move in, there's rollover all up and down that spectrum. But during due diligence, we're going to go in there and renew a lot of leases and give them the opportunity to renew at a better rate than at a point after we do the rehab. For example, in here, we're going to be redoing the atrium completely. And this will also give us space for a nice lobby and reception area for when we have our evening training meetings. There's going to be a nice big lobby area to mix and mingle before you go into our suite for training. As you can see, they advertise that rents are $5 below market. So there is growth and upside. You can see that there's not really any office buildings right around this. We actually like this. It's a little bit off of the freeway, and I'll show you that location in a second. But because of that, the people that live in that area, there's only one real office product opportunity for them to lease, and that is our building. Here is the location. You can see it's right in the middle of 121, 635, 35, and also George Bush. And so easy access from 114. So anywhere in the Metroplex that people are coming from, it's easy access to get to. We love that, especially for our training opportunities. Here's a close-up of the area, right off of MacArthur and Valley Ranch Parkway, right on that corner. So everybody knows where MacArthur is for the most part. And a great location. You can see all the homes right around, plus the Greenbelt area to the east. There's plenty of shopping and restaurants right around the area. So if you need anything, we have easy access to all that. You can also see a great overview of the homes that are in the area, the apartments, the parking area, etc. There's a survey of the property, just so you can get an idea. It's right on the corner. Plenty of parking around the building. So we've got two entrances from the parking area on the east side and the south side, plus the area where they drive-through areas. So if you wanted to drop somebody off, it's raining, etc., there's actually a covered area to drop people off, which is a nice amenity. Here is the first floor plan. We're looking at, excuse me, we're looking at taking this southeast corner, all of this space, and turning that into an education and training center. Now, we're going to set it up for full filming capability so that we can film professionally with lighting and sound and professional equipment, all of the training sessions, so we can put those online and available for everybody. And it'll allow us to expand and have training every week. So that you don't have to come to one meeting a month and get the same information. So we will have it from all levels. We even want to have continuing education training, all real estate training as possible, and record all of it for future use. So that'll be down here on the southeast corner. You can see the hallway goes up to the large atrium in the top left portion of your screen, and an elevator lobby area. It's a very, very nice building, very pretty. You can also see all of the tenants that are in there. Second floor, similar layout, but a big benefit here is on the east and south portion. These are all, they call them mini suites. You can call them executive suites, whatever you want to call them. But these are $30 a foot spaces. The reason, and they're mostly occupied, and the reason for that is if you live in that area, you just need to have an office. And with all of the homes and being a residential area, they just need a place to call home for their office. So they're not looking at a per square foot price, they're looking for a per month price. So for $500 a month, $600 a month, they can have an office space right there in a professional building and a professional location and not have to office out of their house, which is a great benefit. Third floor, no surprises here, same layout, full. Now the demographics, this is important, this is kind of cool. Average, 68% of the people in the area have bachelor's and graduate degrees. The average home price is $317,000. 534 businesses right in that area with 6,000 employees. So this is great demographics. Also, the highest population down here, which is $100,000 to $149,000 in income is the largest segment of the people that live in that area. Now, this one's a real important slide. This is, as of April, off of CoStar, the office buildings in the area. 1.8 million square feet of available space. Under construction, nothing, so there's no competition being brought onto the market. Absorption over the last 12 months, 300,000 square feet. The year before that, 319,000 square feet. So there's continual growth in that area. Absorption, 300,000. Vacancy rate in the area, our vacancy rate is only 3.8%. So office buildings in that area stay full. The market rent, now here's where we get into some things I want you to pay particular attention to. The average market rent in that area is $24.15. Remember that number, $24 is the average market rent. The average market sales price is $195 per square foot, and the market cap rate is 7.2. Keep those numbers in your head. Rent $24, sales price $195, and cap rate of 7.2. Here's an appraisal that was done just a couple months ago, and they're saying that as is, it's worth $10.2 million. Now, I'll tell you what we're paying for it here in a moment, and I am going to switch screens. Remember those numbers. And I'm going to switch over here to our Excel spreadsheet. It popped up for you, and it's waiting for me. Okay. I'm doing 2 pages. This is the investment presentation out of our APM. I'm going to go through everything. Now, I highlighted a couple of cells throughout this, and these are the areas that we can adjust to dumb this down. And dumb down is the wrong word, to make it more conservative, okay? Right now, the way that it's set up is 22% average 5-year return. Now, 22% is extremely high as far as our projections. So what we did is we went in there and made it more conservative, but I want to show you what it looks like to be 22% return. Now, we're paying 9.5. The appraisal was 10.2, so we're paying $700,000 under the as-is appraisal. It's $122 a foot. Now, we have closing costs, capital improvements of $950,000. We'll tell you where that's going in a moment, but we're basically updating and upgrading the building. Put $200,000 in our operating account and $25,000 miscellaneous. We've got loan quotes at $7 million right now. So the total capital we're going to raise is only $4,150,000. We are going to be all in on this property of $143.53. What is the average sales price in the area? $195. So we are 25% below the average sales price on our all-in. Now, 22%. Now, I'm budgeting here a 4% loan, which we're getting quotes in that neighborhood, okay? Now, I'm going to skip over here to the next 2 pages. Now, I added something on these that are not in the PPM, just for calculation purposes. Up in, right here in the middle under Valley Center, 22.3. That's the per year average right now. I'm going to be changing these after we go through them once so that you can see where we're actually projecting. Current rent schedule, $20 a foot average rent. What was the average rent per the CoStar data? $24. So we're way below on that. So even on our projections, we're keeping it at $23 a square foot, which is well below the average rent is right now anyway, even on our projected growth. Important to note, building is 77,686 square feet, built in 1986. On 3.6 acres, the roof is flat. It was replaced in 2018. The HVAC units are new. The electric, these rates above $20 a square foot, that's plus electric. So we bill back for electric. This is a fun thing. The construction is actually concrete frame. So that isn't going anywhere. Condition, I'd consider it a B+ asset. Great condition, great location. 3 stories, glass and brick with slab foundation. Here's what we're looking at doing to the building. $150,000 to update the lobby. Now that lobby, that means repainting, new tile, everything in the inside, and to redo that front lobby to look like a Class A office building or a high-end hotel, something very, very nice. We're updating the 6 bathrooms at $10,000 a piece. Updating the hallways, that's just paint and carpet. You can see on that picture that the trees need to be trimmed and update the landscaping. $40,000 on signage, $20,000 to reskin the elevators and update those. $50,000 in updating all of the lighting. Now that lighting will save us money on electric. $40,000 for the parking lot. Now TI holdback. One of the big differences between apartments and office is that when somebody moves into an office, they usually want it reconfigured to meet their needs. Whereas in an apartment, it is what it is. That's all you get. Now, we have to spend money on tenant improvements, so we're holding back $550,000 for tenant improvements to update the individual suites. Now, if we're spending $950,000, which is updating all those interiors, plus a bunch of money for CapEx for the TI holdback, we should easily be able to get $23 a foot in average rents and probably much more. Here is our assumptions. There's the current from how the owner is operating it right now, and our pro forma. Now, I'm going to go back to these. Bottom line is $8.23 per square foot, which is in line with expenses for a property like that. That's important. Total operating income right now, $1,433,000. Well, all I did was put the rent in there pretty much that we are going to pay. So we're taking our existing rents, adding myself in as a tenant. So we'll have $1,500,000 in income. Now, this gives our cap rate on our purchase price of 9.1 and an 8.7% first-year cash-on-cash return. Now, that's before the sponsor splits, but that's for the property. I'm going to come back to this and show you how it changes when we become more conservative. So here is our 5-year plan. Let me get this centered right. I'm bumping the rents 3%. That's about 63 cents per square foot. On average, out there, normal would be about 50 cents a foot. So this is just a little more aggressive with all of the updates we're doing. And we also have an exit cap rate of 8% for the future. Now, on apartments, the cap rate's a little bit lower because there's a little more stability in the future. But right now, what did that MLS data, what did the CoStar data say? 7.2. Well, we're budgeting an 8% cap rate. On these numbers, 22.3%, you can see up there in the middle, this is what the investors, if you were to invest $100,000, for example, can expect. 6.9% year 1, 8.4 year 2, 9.7 year 3, 11.2 year 4, for a total of 22.3% average return. Now, we need to change this, and let's make it very, very, very conservative, okay? I'm going to hide these numbers above. So we're going to change this to an 8.5% cap rate. Okay, you saw how those are all good numbers. I'm not being aggressive on the current numbers, but now let's make it very, very conservative. Let's change this to an 8.5 cap rate. Okay. Let's change our rental growth to 50 cents a foot. So we'll change this number here to 2.5%. Okay, so now our growth rate is lower than what we anticipated. Now let's bump up these expenses. Say security, they're spending $16,000. Let's make it $20,000. Utilities are $146,000 right now. Now, even though we're updating all of the electric and going to save money on that, let's bump up the amount we're going to spend on utilities, even though we're putting money in to lower those costs. Janitorial, they're spending $86,000 right now. Let's change that to $100,000. HVAC, they're spending $51,000. Let's go ahead and keep that at $50,000. I think it'll be less because of the maintenance we're putting into it. Now, maintenance, we've got $65,000 in there. They have a full-time maintenance person that is on staff that stays at the property all day. Now, a big part of that is because of management. Management is off-site. We will have management on-site now, which should be able to lower that expense, but let's raise it up, okay? So you can see conservative, I changed to an 8.5% cap rate rather than 8. 2.5% on their income growth, which is only 50 cents a foot, which is already built into the current leases at 50 cents a foot bumps. We've increased the expenses to $8.55 a foot. Now let's go over here to, oh, I don't want you to see it. There you are. Now let's change this to an interest rate of 4.5%. Okay. So now, being extremely conservative, we are at 15.2% average investor ROI. And you can see that there. So we are very, very conservative on everything. And even without it being conservative, we're still at a 15.2% return on what is very realistic numbers. Actually, extremely conservative numbers. So this is the reason why we love this building, is there is a ton of upside on the rent, even staying below the current market rents. Our cap rate's lower, our expenses are higher, our growth is lower. So this is a great, great deal in our opinion. And with us as a tenant, we will be paying rent as well. We will also be managing the property. We will have our education and conference center there. We will have our corporate offices there. By the way, the lender will require me to sign a lease that is coterminous with the loan, so that will probably be a 10-year lease. And that makes all of this even better. Great location, great building, spectacular investment. So we are raising $4,150,000 on this deal, and that should fill up pretty quick. Our PPM is not going to be ready till next week as we redo these numbers. And so let's go ahead and see if there are any questions on this so far. So if you have any questions. Okay, here, the questions I have. When will the raise be complete? Now, this will be real fast. We will be complete probably the first week in January. As far as closing, I anticipate closing this about the first week in February. Next question, when will the PPM be available? We're anticipating next week. Now, why are you spending so much, $150,000 on the lobby? Just like apartments, we fix up the property and show the tenants that this is a better asset. When you spend money on the property, you make it more valuable, which will allow for higher rents. And that is the primary reason. But this is also our corporate headquarters, so we want to make sure that we have a nice place for us. And we also want to make sure that we are putting this in a position long-term to be a solid investment. Let's see, is this going to be a training center? Yes, there's also a question. regarding the 5-year hold. We have to put an exit date on our PPM. I did not want to put this out 5 years because there's a possibility that we sell it in 5 years, and if we do, then that's what this return will be. Now, we don't plan on holding it for 5 years. We plan on holding it for longer than that, but we never know what the market's going to do, so we'll decide one way or the other on that part. Let me read some more. If we go out 5 years, I'll have to do a pro forma on that, but the returns will actually get much, much better when you go out that far. Exit strategy. Our exit strategy is we're going to go ahead and lease it up and hold it just like we do on apartments. Same exact exit strategy. Now, depending on our debt, I'm not sure if we're going to be able to have a refinance opportunity. Most likely not. This is just a good, solid cash flowing deal that cash flows from day one. We'll wait about 90 days as usual before we start doing distributions after we buy it to make sure everything's all stabilized. When will DGRE headquarters training facility be operational? That probably won't be operational till March or April, I'm hoping, because we have a lot of tenant improvements to do to get that ready. We will have video equipment in there. We will have open house, so we can start having our meetings there, but the full education and training facility is probably going to be March or April. The next question here. Is there any depreciation write-offs back to investors? Yes, we will still do accelerated depreciation. It's not as good on office buildings as it is on apartments, but all of the tax benefits will pass through pro rata to each individual partner. So any tax benefits you will get. Why do we need a training facility? This is great. As you know, we make money on real estate, not on education and mentoring and training. However, what we do is we provide that as added value to potential partners. So people can come in, get the training, get the education, and then decide to invest. So you don't have to go in and spend $25,000, $30,000 getting educated to decide whether or not you want to invest. This allows us to give free education, so you don't have to spend that amount of money. And we can be more diverse in our training and be able to provide more value to potential investors. Now, even if people never invest with us, that's okay. You can come in and still get the education and training. Next question. Okay, I already went over that as far as different from multifamily. Let me hit a couple other things between multifamily and office. Multifamily, if rents are going up, multifamily is a little bit better because they can adjust rents faster with 12-month leases. In office buildings, you have longer term leases. So if rents are going down, the longer term leases are actually better. So if we're going to hit a time when it goes down, then these longer term leases are better. Also, the cost because of tenant improvements is involved in getting a tenant in there. We need to budget for that so we have a larger holdback for those tenant improvements. And the entity structure is exactly the same. Well, actually, let me take that back. The PPM, one of the reasons where we're a little bit delayed is we're changing this to a 506C, which has a little bit different regulations. But as far as the operating and the benefits to the partners, it's all going to be exactly the same. This is an 80-20 split rather than 85-15 split. So it's a little bit more on our side, but the returns are still spectacular. So that shouldn't be any problem. And depreciation, same thing. Now, on apartments, it's 29.5 years. On office, it's 40 years. So they get spread out over a longer term, but we're still going to be doing cost segregation, bonus depreciation, et cetera, to make that first year a lot better. Are you going to lease out the training center? We are going to make that available for people to use. And quite honestly, it's going to be there. I want it to be used. I want it to be used all the time. So if you have a training center, you have a business, or you have something you want to do, that is available. And we'll put that out there at a very low cost, basically just to pay for some overhead and somebody to operate the equipment, because we want people utilizing it. I would like to have training every day, every night, just to keep that occupied and moving ahead, and basically give an opportunity to everybody. Various leases expiration. Leases expire anywhere from this month, they could be month to month right now, all the way to 3.5, 4 years out, depending on which tenant. We do a whole lease analysis and abstract of each lease, because another difference is it's not a standardized lease. We use a standardized lease, but a lot of times they get lawyers or brokers involved and negotiate certain terms on each one of those leases. So you really need to analyze each and every lease. Now, David Tuttle, our investor relations guy, he's also been an office broker for the last 20 years. And so he's got a lot of experience on that. He will be in-house. He's our in-house investor relations person, but he will also be doing leasing and management of this property and be on site every day. So that's another benefit for us being on site. We'll be able to manage that property better, get higher rents and lower expenses because we are on site. How did this come up? I started off with that. We needed office space. We wanted to bring everybody in-house. We're expanding our management operations. So we're actually going to we're bringing everything in-house. We're also going to be accepting third-party management. And in doing that, we are growing our team. And we need to have a place for all of them to be together. We are actually hiring about 3 or 4 more full-time people. And this is all a benefit to the investors for better control on our side. So we were looking for office space. We went out and looked for lease, and everything was horrible and a lot more expensive. So we went out looking at different office buildings, and this is one that we found. Now, it was actually pulled off the market because, I mean, you saw the appraisal that it appraised, they said basically if it's stabilized, it's worth 10.7 right now. Well, we're buying it for 9.5. Well, the owner pulled it off the market because they were going to go through and invest a bunch of money, get it all fixed back up, and then put it back on the market. Instead, since they pulled it off the market, we still contacted the owner and the brokers that were going to sell it and basically went in there with an offer. We started offering much, much lower and negotiated on this, but still about $1 million lower than what the appraisal is. So we're getting a huge benefit there. I mean, so you could say with $1 million below market, that our $4 million, we're already getting a 25% equity gain just because of that current appraisal, and because it will be stabilized even at a higher occupancy because we are going to go in there and take a bunch of square footage. Also, from our side, is having that education and mentoring education and training center. It's going to save us money because we lease space every month to go ahead and have our events. So this is also a cost savings for us so that we can provide more value and add additional things to it and have more training opportunities. Will this be one of your office or more? Will be done in the future. Yeah, okay. Is this our only office building? Office buildings, all commercial property is the same in the fact that you're not investing in that particular property, you're investing in a stream of cash flows. Office buildings can be good. There is, you need to be a little more careful on office buildings, but they are still great investments. You can see the reason that there's a little bit of difference in the cap rate, because we're buying, well, let me rephrase, they're selling apartments at about a 5 cap right now, and the value of office buildings is about a 7.2% cap. And the reason for that is a little bit more perceived risk because everybody always needs a place to live. And because of all of the growth in our economy and DFW, all of the growth from new businesses moving in and more people moving in, there's a need for more apartments. So there's a little more perceived value in apartments than there are in office, but we will be looking for spectacular investments in the office space because there are great opportunities. Imagine if this were an empty office building, we could go in there and buy it for even much lower, just like apartments, lease it up, fix it up, add additional value, refinance, pull cash out. So that is a possibility if we want to do more office. But we'll get this first one going and prove it up so everybody can love it because we mainly do apartments. This one will be a prove up. Now, I've done plenty of office buildings, invested in them for many years, and so we have plenty of experience in that. Can you speak on your past experience and results in the commercial office space? I can speak to that experience. Let's see here. How many? This is kind of funny. I owned office buildings 20 years ago, and the way that I met David Tuttle is I was a cold call. He was calling on me to sell my current buildings and to do leasing, management, etc. And after his persistence, I finally hired him to go ahead and sell some of my office buildings. Those office buildings did great. I don't remember the exact returns off the top of my head, but they're on our website, I believe. Is office space trending better for purchase than apartments over the next few years? What it is trending better for is better returns than apartments because everybody is chasing apartments, which drives down that cap rate, which drives up the price. Whereas there's a little more stability in the office side. It's not as frothy as apartments are. Front end, but on back end of having educated investors co-sponsors. Let's see, I'm still reading questions. Is reporting the same? Yes, there will be monthly reporting. It's going to be just like it is for all of our other investments. There will be monthly updates. There will be property tours. There will be monthly financials, monthly cash flow, distribution checks. Everything is going to be operating as an investment. For you, as an investor, it's just the same. We are an investment company that invests in real estate. Doesn't matter whether that's office, industrial, apartments, mobile home parks, whatever it may be. The product is a little bit different, but you as an investor see everything exactly the same way. Why is this deal only available to accredited investors? So to hit that again, is we are advertising this. So there are people on the call that have never done business with us before, and we want to make that available to investors. So to do that, we need to be able to advertise. So we have to do a 506C, and part of the regulation for the SEC on that is accredited investors only. So I apologize for that. But we did lower the minimum to help get people in and have a good experience with us. How many square feet will DGRE have, and what would that? I will be renting at that same market rent that we are proposing, and we will have anywhere between 3,000 and 4,000 square feet, depending on what we take. Yes, I'm paying the same amount of rent. Please recap the numbers 1 through 5 using the conservative numbers. We had that in there. That was one of the first slides. Recap that on the conservative numbers. Those are, let me scale back here. With every one of those numbers turning to a conservative number, that's every single one of them, then 6% year one to the partners, 7.2 in year 2, 8.4 in year 3, 9.7 in year 4, and then 11% in year 5, plus if we sell it that year, an additional 30%, giving an average of 15.2. Now, that is extremely conservative on every single one of those numbers. So it's going to be somewhere between that 15.2 and the 22.2 on the more realistic numbers. And back to more questions. How does DGRE earn revenue from education to pay the market rent? We do not make money from the education, and so we make money off of the real estate. We need office space, so as a business, we would be paying for office space either way, so we may as well have that space. We're paying for space to have our meetings in each month, so instead of doing that, we'll be able to offset the cost with having our own permanent space. We will augment that, like I said, with if somebody wants to use the space, just a nominal fee to help cover that. But other than that, it's just my expense. I'll go ahead and hit this. Las Lomas did close today, and distribution should be going out next week. We are, those that invested in Sunset Heights, that money already went out. People had big bonuses in the last couple of days. That ended up being 50 to 60% per year return. And I budgeted on that 26%. So we usually are pretty conservative on our numbers, and that's good. Tribeca already funded also. And Gold Creek is getting ready to close as well. Yay, Sunset. All right, well, that's all the questions we have right now. Like I said, this is an extremely conservative numbers to be at 15.2. Cash flow from day one. And like I said, we're only raising $4,150,000. I fully expect that to be full in the next 2 weeks. We've already had about $500,000 in commitments before we even announced the webinar. We already had people committing. So this will be a great deal, and it'll be our headquarters. We will be there, so that this is solid, great deal, and we're excited to have it. We're excited to have you involved. So make sure to contact David Tuttle if you're interested. David's email, real simple, david@darwingerman.com. And he will be able to set you up and get you a PPM. And that's it. Thank you so much. If you have any questions, feel free to send them over to david@darwingerman.com. He will follow up with you. We will be doing this through IMS because we need the third-party accreditation on being an accredited investor. If you have any questions on that, you can reach out to David also. But we are extremely excited. This is going to be a great deal. We're going to love to have all of our meetings there and grow and expand our investor base to be able to have more deals, more opportunities for you to invest in. But we're still going to keep our conservative stance on what we buy. So thank you so much. Thanks for being on the call, and have a great day.